question that is in my mind. Of course, some small amendments on personal taxation, where he said that if the loan is sanctioned between stipulated dates, then a 50,000 rupee deduction will be available if it is the first residential house. The agreement also provides for some payment which has been made otherwise than by way of cash. That is to say that if I enter an agreement today, but register the sale next year, the guideline value will be taken for today, not the guideline value as of next year, which will be used for registration. But that will be provided some advance is paid by means otherwise than by way of cash. Logically so, because otherwise people would tend to manipulate with an agreement of sale at an earlier date. 54E also he spoke about, and he talked about investment in units of specified funds where there is transfer of long-term capital assets and the investment not exceeding 50 lakhs. These are very quickly some of the changes on the personal taxation front. Coming to some of the changes on corporate taxation, I found one particular proposal which he highlighted quite a bit, where the finance minister was talking about a new section for housing projects, 80IBA. I understand that there are some changes on service tax also relating to housing projects, but I am not sure whether 80IBA will ever achieve anything. It is more or less like our old 80IB10, if I must put it very simply, in most simple language given the time constraints that we are enjoying. 80IB10 almost replica. If you will recall, 80IB10 was more than 1 acre project to be completed within stipulated time. It used to be 5 years, now it is made 3 years. Of course, 1 acre is now made, in case of metros it is 10,000 square feet, other than metros 20,000 square feet, etc. And they say that each house should be 30 square meter, or as the case may be 60 square meter, depending on whether it is in the metros or otherwise. Now 30 square meter translates to 322 square feet. If any of us have not had the time to go and do the calculation, it is 322 square feet. This means that it is a deduction for a house or for what? I do not know whether I didn't say anything. I only asked a question. 322 square feet, most people have better utilities than a house in all. I am afraid this is not going to sell. It is not going, nobody is going to, see, even if you claim nobody is allowing. In fact, I wanted to move an RTI application before department asking how many 80IV10s they have allowed. Somehow, professional constraints have not permitted me to do it, but really speaking, one, they were not going to allow so easily. But here is one section where I think nobody is going to claim. Because if you are talking of 322 square feet in metros and some 644 square feet in non-metros, and if it exceeds that, you are not eligible. And of course, they say that the measurement should be including the projection, including this, including that, etc. Which means if you add the balconies, etc., the common area, of course, excluded, I think it is going to be hardly anything that we are talking of. But suffice it to say that this is on the same lines as 80IB10, subject to some small modifications on the area and on the time frame for completion, which is now 3 years. The finance minister also spoke about promoting employment, which is again a very welcome feature, where he says 80JJAA will be amended to provide that it will be in respect of all entities. All entities, provided there is a 30% additional wages, no requirement that it should be 10% additional workforce, etc. 240 days will be the minimum period for which the employees was work, as against 300 days, which is again welcome. But then the last restriction, which says the salary should not exceed 25,000. That, I think, closes everything. Because if you really look at it, if you are wanting to incentivize only the manufacturing sector, the worker alone, maybe this will work. But if we are talking of software, we are talking of any other industrial establishment, I think 25,000 hardly is going to be, number of employees is going to be so less. Though we don't have a restriction on number of employees, the number of employees is going to be so less that there is not going to be much of, impetus for promoting employment because of this section. It may grow on its own, but not because of this section. Of course, one good redeeming feature is that if you talk from an international tax perspective, switching over, he says this place of effective management will be deferred by a year. And he very clearly said, however, we are going to implement GAR on the stipulated date. I do not know whether GAR or POEM, the place of effective management, either of these are going to come so quickly. Because there are so many unanswered questions in both. Like for example, if you read the memorandum explaining the bill insofar as place of effective management is concerned, he says these are issues that we have not yet addressed and we are not in a position to address as of now. Issues like what about TDS obligation, because you are treating a non-resident as a resident. The minute you treat him as a resident, his advance tax obligations change, his TDS obligations change, his transfer pricing obligations change. All this we don't have answers still, so we cannot implement POEM. I think the same problem we are going to have with the GAR as well. But interestingly, if you see the bill as it stands or as it is presented, one of the objectives of the bill seems to be to reduce the leverage available to assessing officers or discretion available to officers. But I think that provisions like GAR and POEM will bring back discretion. They will not do away with discretion, but on the contrary will bring back discretion in the hands of the officers of the department. Of course, the chairman also spoke about the increase in the limit under 44AD. Interestingly, 44AB, which deals with tax audit, is still left at 1 crore for business. 25 lakhs for profession is increased to 50 lakh. But 44AD, which deals with presumptive taxation, is increased to 2 crores. Logically, AB should have been increased accordingly. But while they have done it for profession, they have not done it for business, probably just a slip. It is probably just a slip. Because anybody who is offering less than that 8% would automatically have to get his books of account audited. And if he is up to 2 crore, in any case, he does not have to get his books of account audited so long as he is under 44AD. So logically, that should have happened. But there is a small trick that the finance minister has left in 44AD. He says if any person who is an eligible assessee opts out of 44AD, then for the next 5 years, he shall not be entitled to the benefit of offering that 8% without tax audit. He shall be subject to tax audit, which means that even a person who is offering lesser, who has earned lesser, will now have to probably reconcile to the fact that he has to offer 8%. And logically, of course, he would get capitalization of that amount, which supposing he earns 14% next year and only 4% this year, he can average. He can average and say, yes, I earned it over 1 year, 2 years instead of 1 year, that's all. So that much capitalization benefit he may get, but that's the trick that he has left. Again, for professionals, up to 50 lakhs, he is seeking to insert a provision where it will be that the professional will have to offer 50% as the net income, of course subject to deduction. I don't make 50%. Of course, I don't fall within the 50 lakh bracket, I am sure. That also I must concede. But I don't make 50%, that is for a fact. That is for a fact. I really don't know how many of the professionals make this 50%. Well, that is one aspect. He is also proposing to amend 47, conversion of a company into an LLP, where he says the turnover will be increased to 5 crores for the preceding 3 years, as against 60 lakhs, which is presently there. I think this is again very redeeming because 60 lakhs was such an abysmal number. 60 lakhs, in fact, there was a small catch in that. It said 60 lakhs for the preceding 3 years. So for the year of conversion, it can be anything. It is only for the preceding 3 years. That continues. For the year of conversion, it can be anything. Preceding 3 years, he is proposing to make it 5 crores. Now that is probably one area which is quite redeeming. He is also planning some small changes on TCS. Of course, small change but very, very far reaching and probably necessary. It is proposed that there will be a TCS on all motor vehicle purchases exceeding 10 lakh. Exceeding 10 lakh. If the payment is made otherwise than by an account pay check or it is paid in cash. I'll put it that way. Likewise, for all services exceeding 2 lakh, there will be a TCS of 1%. But these two are subject to the fact that if they are paid by check, then this, or banking channels I'll put it, then this does not apply. Likewise, if we look at it in respect of services, they say if TDS is applicable, TCS will not apply. TDS, of course, they are rationalizing some of the limits, and one other welcome feature, or I will say slightly redeeming feature, will be the fact that they are proposing that 15G and 15H can be given even by persons earning rental income. I think this is a great feature because many of the persons who are earning in rental income could be senior citizens and or people who have retired, senior citizens, people earning passive income due to various reasons. I am not saying everybody is, but a substantial number are. And they had to approach the assessing officer every time in terms of 197 for a lower deduction certificate or a nil deduction certificate. Now there is a self-declaration possible through a 15G or 15H, in which case there is no need for a deduction of tax at source, which would be something which will be very, very useful, particularly for people who have no other active stream of income and otherwise have nothing to do with the department at all. You know, where I may have nothing, because the basic exemption is 3 lakh, say for example, if I am a senior citizen, and I get a 1.8 lakh rental income, I am subject to TDS. Whereas my actual income, after I take off that 30% deduction, etc., would be much lesser, about 1.5 lakh is all I remain with. And for that, I don't have to approach the department for a nil deduction certificate, which is a very good thing. They are also proposing to make substantial amendments on the procedures. I should say not substantial, very, very substantial, both in terms of the procedures and the penalties. In fact, those are the areas where the maximum concentration has been on, not merely on some of the sections where they have just thrown away some small incentives here or there. In fact, if you look at it, it is proposed that all the incentives that are presently available, almost literally, would be phased off and reduced over a period of time, which we will probably discuss as we proceed. Now, insofar as the procedures are concerned, first thing is he has provided, or the finance bill provides, that paperless notices can be issued. Second thing that the finance bill provides for is that if there is an assessment that is happening, then it is possible that a hearing will include all papers sent through any electronic mode. Which means if I send an email to the officer, I have responded to the hearing. They are saying we want to avoid or we want to promote faceless assessments, which, you know, in the long run can promote so many better things that would be there. The next change, again interestingly, is in respect of filing a belated return. A belated return presently can be filed under 139(4) before 1 year from the end of the relevant assessment year or completion of assessment, whichever is earlier. They are proposing to amend this to bring it down to before the end of the relevant assessment year. Not 1 year from the end of the relevant assessment year, but before the end of the relevant assessment year. You know, to date, we were looking at the end of the assessment year only from the point of view of 271F, that 5,000 rupee penalty. But hereafter, a belated return also has to be filed within that time, which means that if you file a return thereafter, it would become an invalid return. It would become an invalid return, and the assessing officer will have to proceed for an assessment, if at all, through issuance of 148, and so many other consequences could follow. At the same time, a very redeeming feature, I should say, is the amendment in 139(5). 139(5) presently permits filing a revised return if a person finds an omission or wrong statement in a return filed under 139(1) within 1 year from end of relevant assessment year or before completion of the assessment, whichever is earlier. Now that time frame, 1 year from end of assessment year or before completion of assessment, is kept as such. But they are amending the provisions of 139(5) to also include a belated return, which hitherto could not be done. If a belated return was filed, it could not have been revised in terms of 139(5). By virtue of this proposal, when it becomes law, an assessee can revise the return even if it is a belated return, which to my mind is a great redeeming factor. So that is, in a way, while the time for filing a original return in terms of 139(4) has been restricted to some extent, there is also a redemption in the fact that that return is capable of being revised if there is a omission or wrong statement in the return. The other amendment in the procedure, this happens every 2 years, so nothing great. 2 years have gone, so it has happened. Originally, if you will recall, the time for completing assessment was 2 years from end of relevant assessment year. Then they amended it to say that it should become 21 months from the end of the financial year. Then they said, no, we will make it 3 years from end of relevant assessment year. Now they are bringing it back to 21 months from the end of the financial year. So this has become a routine. Right? 36 months is now being made 33 months effectively, once more. This will apply in respect of regular assessment. For reassessment, similarly, what used to be 2 years is now made 1 year and 9 months. For set-aside assessments, what used to be 12 months from the end of the financial year is now made 9 months from the end of the financial year. Everywhere substituted or reduced by 3 months. Now, though this relates to a procedure in relation to tribunal, I will still take it here. There was one drafting lacuna in the earlier, in the act as it was stood prior to the, or even today I will say, the proposal may rectify it. See, unfortunately what happened was that while making the amendments, the DRP appeals which were filed by revenue, they had not given an exclusion for the department from payment of fees. Normally when the department files an appeal to the tribunal, no fee is payable. But when an appeal emanated from a DRP's order, fee was payable even by the revenue. In fact, there is a Hyderabad bench decision where the tribunal said that since fee is not paid, the appeal is to be dismissed. Now they are trying to make a statutory amendment retrospectively from 2012 when DRP orders became appealable to provide that no fee is payable. In fact, the biggest nuisance because of this is, because of this reason, benches are adjourning matters. See, I have cases where assessee appeal and revenue appeal are clubbed together. Because the bench will have to dismiss the revenue appeal, they are saying we'll adjourn. And until they adjourn, the department is pushing me for the payment of fees. I am not asking adjournment. I am not asking adjournment. I am ready with the case for the last 4 months, 6 months, whatever. But our first prayer is that, in fact, I have a miscellaneous petition coming up on 4th here in the Chennai Tribunal itself, where interestingly, the department has said you have not adjudicated one ground. I have moved a miscellaneous petition saying you should not have adjudicated the appeal at all. In the first place, why this ground? So this is all going on, that confusion they are trying to put at rest. While this is said, again they are going back to one more thing which we had in the past, DRP orders not to be appealable. Earlier we had a situation where assessments were framed on the basis of DRP orders, no appeal. Then the amendment came to say it is appealable. Now they are going back and saying not appealable. Now I really do not know whether this is good or bad. In the sense that originally the idea was to put an end to litigation through a dispute resolution panel. Laudable objective. But if you looked in practice, nobody literally got any relief from DRP. 0% relief. I remember that in Chennai, out of the total disposals that were made in 1 year, 2 cases they had a relief. One case was reasonably big amount. The other case they allowed some 2,400 rupees. Income, not tax. So you can divide it by 3 and find out what is the tax relief the assessee got. And that was for a multinational which had declared a loss of some 40-50 crores. So it made no difference. So that is how the DRP was. Fortunately, when it became appealable, there was a slightly better attitude taken by the members. I am not saying it should be made appealable, but the attitude was was better, and they were allowing relief. Now, when this comes back, I am afraid we are going to go back to the old scenario. I think some of the things that happen can happen by legislative amendments. But many of the things that happen have to happen by attitudinal change. They have to happen as a result of an attitudinal change and not merely as a result of a legislative amendment. So unless the DRPs are told that they can or they should give relief where it is possible. In fact, I am given to understand recently many commissioners appeal are saying they are going to make appellate orders subject to audit. I am not for one, saying that appellate orders should be subject to audit, but for sure, if they are going to bring an audit, it should be both ways. It is not merely a relief that has been granted to assessee which should be highlighted, but the harassment that has been caused to an assessee. See, I have cases where I cite a Supreme Court on a point of law before the Commissioner Appeal. The Commissioner Appeal does not even mention it in the order, in the finding, though he reproduces my entire submission, including Supreme Court. I have orders like that, and he holds against SC. So, nobody can distinguish law, somebody can distinguish facts. These are questions of law. I am not on a question of fact at all. So, therefore, if they are bringing up an audit, whether it is at the DRP level or at a Commissioner Appeal level or at any level, I would think that it should be also with a view to ensuring that any harassment caused to SC is put an end to. There is a rectification insofar as the time limit for rectifying by the tribunal is concerned, which says the rectification should be made within 6 months from the end of the month in which the order is passed. I am quite surprised. Why this restriction for tribunal alone? Why not for an officer? Why should an officer be given 4 years from the end of the financial year? The tribunal brought down to 6 months. In fact, if you will recollect, the power to rectify today on an application from SC is within 6 months from the end of the month in which the application is made. The board has come out with a circular recently. The board has come out with a circular recently saying that even in a case where the 6 months has gone past, you should rectify. Now, interestingly, we have a decision of the Supreme Court on 12A where they say if you have not passed an order granting or refusing to grant registration to a trust within 6 months, the application is deemed to have been allowed, which means the rectification also is deemed to have been allowed. Now, what happens to tribunal? Why should that alone be brought down to 6 months is something which beats me. I am not saying bringing down the time is wrong, but they can bring it all across on all rectifications. 281B is amended to say that if there is an attachment of a property provisionally made, then it can be substituted with a bank guarantee and the provisional attachment can be lifted. This is as though, property is going to be removed from attachment, sold, etc. Nothing is going to happen. No property is selling in the market. Why will somebody go and give a bank guarantee and release the property? He will as well keep the property. At least for next 2 years, this amendment will be of no use, but in future maybe. In future maybe. Property, whatever price you quote, is not going to sell. Right? Next is again a very, very welcome amendment where they say that during the first appeal, if the assessee pays 15% of the disputed tax, it talks about 15% of the disputed tax, but this is not coming through the bill, this is coming through the finance minister's speech alone. If a person agrees to pay 15% of the disputed tax, then the stay will be automatic, which is going to be a very, very dreaming thing. Of course, if it is very high-pitched assessments, then even this doesn't work. Of course, it doesn't mean that if you don't agree to 15%, no stay should be granted. It is not like your indirect tax where you have a pre-deposit, etc. Waiver, they also may have a waiver. Here, the assessing officer can also grant stay even where you don't agree to pay 15%, or you can go to the higher authorities as well. That is still permissible. This, they say, will come through an instruction by the board. They say it will come through an instruction by the board, but the language used in the FM speech is 15% of the disputed tax, not interest. If that is followed in letter and spirit, maybe it will do a lot of good. Because today, in reopened assessments, we see that the interest is 2 to 3 times of the tax itself in very many cases. Penalties. Substantial amendments in penalties. In fact, as I was talking, I was telling Vaidishwaran as we were walking down, we are so used to standing up in the tribunal and saying, Your Honours, 1C. Everybody knows 1C means we are referring to 271 1C. But now they are proposing that 271 1C will get scrapped. So first of all, it comes as a shocker, not using the term 1C. That's all. We're so used to it. They are seeking to do away with the existing penalty scheme in its entirety and seeking to provide some kind of a carrot and stick also by bringing a new to section 270A and also 270AA. Now, if you see 270A and 270AA, now what they are saying is that if there is a bona fide error, or if the income is estimated, or if the entire material facts relating to the addition are disclosed, or if the addition is made even where the information and documents prescribed under transfer pricing regulations 92D are maintained, and all material facts are disclosed in that study, then no penalty. Let's be clear. Bona fide explanation, estimated additions, disclosed facts, or if it is disclosed through the transfer pricing documentation, no penalty. Next, if you have underreported income and don't fall under the first category, the penalty is 50% of the tax. And if you have not underreported but misreported, then it is 200% of the tax. Now, what is misreporting, they say, is misrepresentation or suppression of facts, non-recording of investment in books, claiming expenditure not substantiated by evidence, recording false entry in books, failure to record any receipt in books, failure to report international transactions. Now, I can understand some of these saying recording false entry in books. Non-recording of investment in books. Many assessees are not even required to maintain books. What does such an assessee do? Next, they are talking misrepresentation or suppression of facts. Now, again, they are seeking to remove subjectivity, but this itself leads to subjectivity. But what disturbs me most is claiming expenditure not substantiated by evidence. Now, what is the evidence they are talking of? Is it external or internal evidences? I know a number of assessees who cannot have vouchers with supporting documents. They will have only vouchers. Is that evidence or is that not evidence? The only saving grace there can be that you will have to sit with the officer and tell him, reject my books because I don't have proper vouchers, estimate my income. So I go out of the 50% also. That can be the only way. Otherwise, external evidence, I am sure each and every assessee will have at least one voucher. If I travel by an auto, what voucher I can have? You tell me, I came here by an auto, I will claim this as office expense. What voucher do I have? I don't have any voucher. Right? Like this, there are assessees who cannot maintain vouchers at all also. See, for example, I know one person who puts a set for cinemas. That's his job. He takes contract for putting up sets for cinemas. Now, he hires the local workers there, whoever is there in that region. Nothing he can get from them. Even if you get a thumb impression, that thumb impression is all you have. All manual laborers, that's all he has. Now, what do you do if the department says you are not having proper evidences and therefore you have misreported, which means you are liable for a penalty of 200%. This could again be an area of concern. I think that is something where they need to give more clarity. Of course, they are amending or seeking to amend 271 AAB, which seeks to levy a penalty in search cases where it is a graded penalty. 10% if you have made the offer under 132(4) and paid the taxes. This is for the year of search and the previous year where the due date for filing return has not ended. If you have stated the manner in which you earned the income and paid the taxes, 10%. If you have stated the manner of earning the income alone, 20%. If you have not even stated the manner of earning income, then it is 30%. It is 30% of the income or 10% or 20% of the income, which means it will be not 10% of the tax, something that we need, because we normally associate penalty as a percentage of tax. That's not how it would be. Now, coming back, 271 AAB now provides the last circumstance can be 30 to 90%. Now they are saying no, it will not be 30 to 90%. We will make it flat 60%, average. Neither 30 nor 60%. Now that's the other thing. Now they are also bringing proposing to bring in a new section 270AA, which is for waiver of penalty. Now, if a person is liable for penalty at 50%, which we discussed a little earlier, because of the fact that he has underreported income, I'm finding it difficult to get to new names, because we are used to concealment or furnishing of inaccurate particulars. Now they are using the word underreporting and misreporting. Right? So if somebody has underreported income, then he is liable for a penalty at 50% of the tax. Now in such cases, we are proposing that the penalty can be waived. The penalty can be waived provided the tax and the interest is fully paid and no appeal is preferred against this order within the statutory time. And they say that the officer will automatically have to ensure that the penalty is waived. And if you are not happy with this order, you cannot go in appeal, etc. It is a final order. Your remedies before the higher authorities in the administrative wing to show that you have complied with the conditions would still be there. There are again two major aspects that are sought to be brought in through the finance bill. One is they are proposing that there will be an income declaration scheme. And two is they are proposing that there will be a dispute resolution scheme, both of 2016. Now the income declaration scheme is on these lines. It's something like a one-time compliance. The date is to be notified, the rules are to be notified, everything is to be notified. As of today, we only know from the finance bill who are the assessees who are probably eligible to go and what will be the damage. It looks pretty interesting, where they say that you will pay, if you make any disclosure of income, you will pay tax at 30%. You would pay surcharge at 25% of the tax, which means 7.5%. You would pay a penalty at 25% of the tax, which is another 7.5%. Which means that if you want to go under this one-time compliance, you pay 45% as tax. Very cheap. Because if you go with tax and interest, it can be much, much more. There is very little clarity on what will happen in respect of interest. Right? It talks of tax, surcharge and penalty. Probably in my understanding, the interest should be payable on this. I don't see why the interest will not be payable. However, certain SCs are not eligible. SCs who have received notices under any provision of the Act, 142.1, 148, 143.2, 153A, 153C, anybody who has received a notice in terms of these provisions, for those years is prohibited from entering this scheme. 2, if a search or survey has been conducted and if the time for issuance of notice is not expired. 3, if the person is a person who is covered by the Black Money Act, that is where he has foreign assets which are undisclosed, he cannot come into this, then he should have gone under the Black Money Act, which if he has not done will be liable for all consequences under the Black Money Act. Similarly, where information has been received from foreign countries, where even he was prohibited from entering the Black Money Act. Of course, there are also a series of other persons, where they say you will not be covered, that is for persons who are covered by Corruption Act, etc., 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 which is a normal thing. This seems to be more or less in lines with the voluntary disclosure of income scheme. They seem to have invented new terminologies. The terminology now is one-time compliance window. Earlier it used to be called voluntary disclosure, probably because Supreme Court has come down heavily on voluntary disclosure schemes being awarded and getting, allowing SSCs to get away with payment of lesser taxes, evaders to get away. They are now coining a new term. So they would probably not be subject to audit. In fact, Black Money Act was one act where many people asked, probably why they can throw more light, why nobody is challenging it. Now the problem was, the fellow who has cannot go and challenge. He wants to get rid of it by filing. So if he challenges, it will go. The fellow who has but does not want to disclose, if he goes and challenges, the first question anybody will ask is, do you have? So everybody was keeping quiet. Now I think this act would get subject to challenge when a notice is issued under the Act not for this one-time compliance, but when you cross the one-time compliance and have to face the consequences. At that time, people would probably challenge the Black Money Act. However, that is not relevant for the present discussion in the sense that people who are covered by the Black Money Act cannot come to this scheme. They are also talking of a dispute resolution scheme, which will be on or after 1/4/2016, but on or before a date to be notified. Now, I am quite 1/6/2016, I am sorry. Now, the trick seems to be like this. I do not know why they are making or bringing in the provisions in this fashion. They are saying that if there is any tax and penalty that is determined under the income tax or wealth tax, and if the assessment or the penalty proceedings have been subjected to appeal before Commissioner Appeal and are pending before Commissioner Appeal, then you could pay the tax and interest up to the date of assessment, and the appeal will have to be withdrawn. However, if the tax exceeds 10 lakh, you also have to pay 25% of the minimum penalty. That is, the minimum penalty is 30%. That is 100% of the tax. So you pay 25% of that 30%, and you will get the same benefit if it exceeds 10 lakh. If it does not exceed 10 lakh, then you pay only the tax and come out. This again seems to be like our old Karvivad Samadhan scheme, if you will recall, but with a different name. Now, what defeats me is, why should they restrict this? Why should they restrict this only to appeals pending before Commissioner Appeal? I would have thought it should be extended to all appeals pending at any level, whether pending as a result of an appeal by the SSC or the revenue. Even a revenue appeal, if somebody is willing to pay the penalty and walk out, after winning in Commissioner Appeal and Tribunal, appeal is pending in High Court, department has such a bleak chance of success, somebody is willing to pay the tax plus some penalty and walk out, leave him, would be the best thing. I'm quite surprised when they are talking about, saying that it should be pending before Commissioner Appeal. I think the scope should be far more expanded, and it will do a lot more good both for the revenue and for SSCs, because today the cost of litigation, the time spent on litigation, the energy spent on litigation are so huge. And it is not worth paying any counsel who is arguing a matter, including me. Because at the end of the day, it gives no finality to any problem. Any problem is not solved as a result of winning an appeal or losing an appeal. Assessing officer is the best person. If you cross assessing officer, then you are subject to two things. One, perpetual litigation probably, and two, vagaries of every appellate authority. Vagaries of every appellate forum. It is certainly there because every person has a mindset. Now, I would personally think that we should make a memorandum to expand the scope of this. Having thought of it, why restrict it to CIT appeal? Even if they want, if CIT appeal is held against SSC, let them not expand it. Because they will say, I have that much more a stronger case. Let them not expand it. But if CIT appeal is held in favor, let them allow the SC to exit by payment of tax and penalty. That will be a great thing to do. Right. Now coming back, they are also talking about waiver of interest and penalty, where they say there should be a time limit of 1 year to finalize or pass an order granting or not granting the waiver. Now again, this leads me back to the Supreme Court decision in the context of 12A, which was rendered just about a couple of weeks back, where the Supreme Court says that if there is a failure to pass an order granting or refusing to grant, then it is deemed to have been granted. The same will apply in respect of this amendment, where they are saying 222A and 272A waiver applications should be passed within 12 months from the end of the month in which the application is made. Failure should not logically lead to the conclusion that it is deemed to have been granted. Because sometimes it's very funny. If it is deemed not to be granted, what should I write in the grounds of appeal? The commissioner ought not to have slept for 12 months. Can I write a ground like this? Only if there is a speaking order, I can write a ground on it. If there is no order, what ground do I write on it? And what is the fun in going to the writ court? The writ court saying, okay, the commissioner to pass the order, which anyway the law mandated him to. Why should he wait for a court order and then pass? There is one other tax that is sought to be introduced, which is called an equalization levy. This will be a very, very funny thing, and I am sure this is just a humble beginning to something that is much bigger. If you will recall how service tax started a few years back with 1% on only 3 services. And today it is how much? 14 and 14, 15, whatever percentage. 15% on all services. In fact, disservices also. Everything. So this is a beginning in my view. The equalization tax is just a beginning, and I am sure it's going to lead to large scale disputes over time. Equalization levy is very simple. It says in respect of specified services where the non-resident does not have a permanent establishment in India, where the aggregate value of services does not or exceeds 1 lakh, and 3, where the person who is making the payment in the course of his business or profession, then there is a levy of 6% as an equalization levy. If he has a PE, then the profits attributable to the PE will be taxable. If he does not have a PE, then 6%. Right? But of course, subject to the fact that if the payment is within 1 lakh, or if the payment is not made in the course of business or profession of the assessee, the payer, then it will not apply. Now, what is a specified service they are saying? A specified service means online advertisement, any provision for digital advertisement space, or any other facility or service for the purpose of online advertisement, and includes any other service as may be notified by the central government in this behalf. So today you are talking of only advertisement, online advertisement, nothing more. Any other service that may be notified by the central government, they don't even have to amend this provision. At least in service tax, every year they have had to amend the law, table it in parliament. Whereas once this comes, they don't have to do anything. Central government has to notify. Tomorrow I'll ask you a simple question. If they say commission payment, until today you commission payment, Madras High Court, Farida Shoes, Faizan Shoes, any number of high courts are there on the subject saying it is not subject to TDS. Now this equalization levy is like a TDS. They are going to add 6%. And corresponding amendments, mind you, are made in 40A to provide that the expenditure will not be allowed as a reduction. On the one hand, the 6% can be levied, collected from you. On the other, it will not be allowed as a reduction. Now please note that this is going to be the singularly largest or the most dangerous provision in the whole of this bill. That's why I kept it for the last. Right? Because if I started with this, probably most of us would have been wondering how we're going to survive at all. But I am sure the government is going to add all kinds of services in the list, and it is going to create more tax revenue than the whole of the Income Tax Act if they go at this rate. See, that's all. See, my understanding is if somebody does not have a permanent establishment in India, why should he be taxed in India at all? There is absolutely no rationale. The fact that they are seeking to tax it itself is obnoxious, and going further, they are just leaving with the powers to notify with the central government. It doesn't even have to come through an act, like the service tax comes, which is the next biggest danger. Friends, let me tell you that in the limited time, there are few more changes as well, I must admit. In the limited time, this is what I could really set my eyes on. Even this was, because this time the number of changes in the finance bill in relation to direct taxes is at least twice as many as in the last 5 years. Huge changes. Probably we need to sit and deliberate a lot more. And as the chairman put it, third, we would be slightly better. And in the middle of March, we would be way ahead, being able to analyze clause by clause. Friends, in this limited time, these were probably the amendments which were most far-reaching. Therefore, I sought to take this up first. There are other changes as well, which probably I must admit I myself may not have read so far. But I must thank the organizers for giving me this opportunity, because 2.5 hours is all you get from the time you get the finance bill in your hand to start getting into your car to come to here. 2.5 hours, I'm sure I would not have done this much, but for the fact that the organizers chose me. And that's the singular reason why I agree year after year. I agree because otherwise I will not read. I am not as industrious as you think I am. I will happily go to sleep or do something more, which is probably more my priority for tomorrow. This is like, sir, how many times I have come to Tirupati will be probably more than the times you have gone. You are from Tirupati itself. People from here go. We will not go to a temple in the neighborhood. We will go all the way somewhere and do it. And that's how I was supposed to read this. Thank you, friends, for a very patient hearing.
So that is the bubbling energy. An energetic man, tall man, has put in a tall order. So we are fortunate to have such an eminent faculty and who is graciously obliging our requests year after year. So now we are having the second part of this budget, the indirect taxes. As usual, we have requested our advocate K. Vaidiswaran. Just a brief introduction. He needs no introduction in Chennai, but anyhow, Vaidiswaran is an advocate. That is from Madras Law College. He got the law degree in 1990. He's also a cost accountant and completed his company secretaryship courses, but not enrolled as a member. And his areas of practice are indirect tax. Actually started his own legal practice in Chennai with an office in Bangalore in the 2000, providing full legal service in the field of direct and indirect taxes, legal due diligence, advisory, and M&A transactions, corporate law, and FIMA. He has been the speaker on GST, VAT, service tax, excise, customs, income tax, and FIMA in various seminars organized by CAI, MCCI, ICAI, IASC, SCC, SICC across the country, and faculty for indirect taxes for CA final students. He is a domain expert on VAT and service tax in the country, handling variety of issues arising all over the country, and currently member of various committees in southern region. He has published 3 books, VAT in India in 2005, and SENVAT Demystified for Professionals in 2008, and the handbook on indirect taxes for CA final students. That is running the 12th edition. So besides all these things, a basic human being, never assuming any position by virtue of his eminency in that particular field. And even for CA students, when I requested him for Tirupati or number of times, wherever we call, sir, for CA students' benefit, you should travel a long distance means. Even when the students' conference are not afford to give him the flight ticket, he used to travel along with us. So that is the humility and down-to-earth approach of our eminent faculty today, Sri Vaidiswaran. I request you, sir, to come and take.
Good evening, friends. My friend Bhanu, elected dignitaries on the dais, friends of the dais. Normally it's a very big challenge when you try to read up on the finance bill and come for a discussion. And to some extent, I would say Bhanu's luckier than me. He just has to read the finance bill, changes made in the finance bill, quickly glance through, and with his experience, he can quickly grasp the provisions. For me, it is even more a challenge. There is a finance bill. Then there is a set of notifications called as tariff notifications. Then there is a set of notifications called non-tariff notifications. So tariff notification, non-tariff in central excise, tariff and non-tariff in customs. Then there is a service tax set of notifications. Then there is a SENVAT credit rules amendment. And then 2 complex circulars explaining everything in a different way. And in that circular, by the way, they will clarify other points that are also not in the budget. And I can't take it for granted because today the audience is very knowledgeable. So para number 43 of so-and-so circular, what is your view? I would have seen para number 43 also. So it's quite a challenge, but we have to rise to the challenge, and that's why I'm here. First, let me talk about the budget. He started his conversation with whether it's a good budget or a bad budget. I know people ask you to rate also. These days, how much would you rate the budget? At least luckily this time the institute was nice enough to ask, some years back they called me and said, 2 days before the budget, when are you sending the material? You also got this. That was quite a shocking experience for me. I said it will be absolutely illegal if I can send you materials. Anyway, but the material today is available digitally. By 1 o'clock, the whole thing is available on the web and people are able to read. And interestingly, one of the significant amendments in the legislation is they are getting rid of this concept of an age-old concept of sending an exemption notification for publication in the format prescribed under Section 5A of the Central Excise Act. They are getting rid of it finally. Interestingly, there is a Supreme Court judgment as to what is the change in law. How do you know what is the law has changed? The assessee had argued saying that please read so-and-so Central Excise rules published by so-and-so publisher. The court said no, they could be wrong. Then the assessee's counsel argued saying that look at the website of the government, that is not prepared by the higher officials, it's prepared by the lower officials. You give me the actual text of the Gazette copy, I will see. In that Gazette copy, the word was different compared to the published versions. It made a huge difference. So now we are going into a complete E-mode where, getting rid of even notifications. Now coming quickly to his budget, I thought this was one of the most sculpted budgets. If you go through the way he started, he said the entire budget is based on 9 pillars. And he referred to each of those pillars, and for each of those pillars, he had something relevant. Right from agriculture, moving on to rural, going on to social, jumping to infrastructure, going into banking sector, going into governance, going into tax reforms, going into resource mobilization. Every single pillar had brilliant ideas. And this is something like an artist, when somebody is trying to draw a picture, there are a lot of small things which are ultimately connected. You get a very big picture, a beautiful picture. And that is exactly what I see. Phenomenal allocations across sectors, targeted allocations, clever provisions, and then to back it up, resources, very structured. Money has to come. All of us are clear that, and to maintain the deficit at that level, money has to come. So where is the money going to come? Everybody was looking forward to, and they have identified sectors where money can come. So let me quickly take Central Excise, what they've done. This is an age-old game which we play. We bring one levy, and somebody is not happy about it, we remove it. Then 5 years later realize that, no, this levy should actually be there, bring it back again. Then the same people who are unhappy make a lot of noise, then remove it again. Now bring it back again. We are talking about jewelry. So from tomorrow, by the way, it's from tomorrow. That's another beauty of Central Excise and Customs, which again Bhanu does not have to bother about. They have this act called as Provisional Collection of Duties Act. An amendment in the finance bill can be notified under the Provisional Collection of Duties Act. Therefore, it takes effect next day. So from tomorrow, we have changes. Excise duty is applicable at the rate of 1% on jewelry. Fair enough. But jewelry is such a complex business. We may see so many jewelers, we may understand families who purchase jewelry, we may understand celebrities who purchase jewelry in terms of the entire family going and purchasing and all that. But despite all that, you may be surprised that many of the topmost jewelers may not actually manufacture the jewelry. The jewelry is manufactured by artisans and job workers across spread length and breadth of the country who carry those valuable jewelry in small manjapais across the country. They will be so obnoxious, they will not even be known as if they're carrying valuable jewelry. Now the jewelry process itself is so beautiful that the gold gets cut, gets melted, and then designed and then shaped into jewelry, and then all kinds of cleaning happens, and then the hallmarking happens. And by the way, jewelry color also different. Kerala, it's a different kind of color, the excess coating in color. Tamil Nadu is a different kind of color, the coating is done. So a lot of chemicals are also added. So under excise law, manufacturer has to pay. Now all these fellows, thousands of job workers are manufacturers who are not known where they are. They operate in circles where you can't even identify them. They won't have a pakka factory saying that job worker jewelry private limited. No? Like that, they will not have that. So they will be hidden somewhere in some basements. So obviously our lawmakers understand this. They said that whoever engages the job worker by giving the material is the manufacturer, he should pay excise duty. So all the persons who are going to engage job workers are manufacturers, they are liable to pay excise duty from tomorrow. And luckily government has also understood their problems and they've said that don't worry, you can get registration in 2 days. After registration, nobody is going to come and physically verify your premises. You need not give stock statement. They kind of read the mindset of what all questions were typically asked and said that you don't have to give stock statement. We will not come and see you. We will not verify you. You register and start paying. So this 1% jewelry concept, duty concept has come. There are tricky issues here also because you will have multiple locations, multiple factories. There are companies that have multiple factories. So they say we'll give you a centralized registration concept also. Also all part of it today itself. And then comes the practical side which they are not able to address. Under excise law, you pay duty when you remove the goods. Whether you are selling or not is irrelevant. So jewelry, somebody can buy and remove it, which means excise duty is payable. But the beauty of jewelry is that this lady comes to the shop and picks up a particular design. She's been a customer for 25 years. Then she tells the shopkeeper, look, I like this jewelry, but it has to be cleared. So the jeweler genuinely asks the question, husband has to clear? No, he has no role to play in this. My neighbor has to clear it, so I have to show it to her. I'll show her she's gone out of town. Can I bring it back after 2 weeks? No problem, madam. Trust, 25 years. So goods go out. Technically, removal has happened. 2 weeks later, she comes back, says, my neighbor doesn't like this. I don't want this. Shopkeeper takes it back. Now, under excise law, once you have removed, you have to pay duty. Once you have paid duty, you are finished. So people have to either revolutionize their business and deal differently. Of course, now today, jewelry seems to be one kind of boxes where they hit you from PAN number to TCS and in terms of excise duty. So all this coupled together and 1% VAT comes after excise duty. So there will be a difficult cascade on this cycle. But this has come to stay. Electronics and telecom sector, they've made some changes to ensure, see, lot of exemptions have been withdrawn. I was in the channel today in the morning where I made a very simple point saying that before Pongal, you clean up your entire house. You try to remove all kinds of stuff which have accumulated over a period of time. That is exactly what is being done. They are reviewing all the exemptions and wherever unwarranted exemptions exist, they are slowly removing them so that when you are ready for GST, you are being ready to get into a high rate of tax in GST. So we are seeing that in terms of certain changes. Third levy is an excise duty on ready-made garments. This is again, once it came, then went away, then again it came back. Now it's finally come back in this format, whereby 2% without SENVAT, 12.5% with SENVAT credit based on RSP, retail sale price. There the same problem like jewelry arises. The person who manufactures the jewelry does not own the brand. The person who owns the brand does not manufacture the jewelry. Therefore, they said, the person who is a brand owner, who has engaged somebody else to make the ready-made garment, is the manufacturer. Please pay excise duty. So all kinds of old notifications and circulars have been revisited and they've all been reintroduced. In fact, the finance bill goes on to say that, look, we have had all this tamasha before itself. We have issued one circular in 2011. That circular will apply now. So the way it goes, I think at the bureaucrat level, they just revisit what all has happened. This is something which we withdrew. Okay, put it back. Something like that. That's how it's been done in some of the areas. And then there is a favorite bashing segments. You have these beverages which they don't like, added sugar, health, obesity. Okay, hit them with more duty. Then there is cigarettes, perpetual bashing. And this time, 3 to 4 times increase in duty. Phenomenal rates increase in duty. I don't know. Last year itself, when they increased the excise duty on cigarettes, both filter and non-filter. I'm not a smoker, by the way. When they increase, you have to do research, no other choice. So when they did this increase in duty, it was found that the business of these organized companies came down significantly, and unorganized smoking, cigarette manufacturing increased like anything. They were not even paying duty, and they didn't have those kind of sophisticated filtering to extent. At least the cancer would have come a little more later, from an organized sector compared to the unorganized sector. So if the government is so keen and so obsessed about health and so paranoid about people smoking away and killing themselves, ban it. Use your legislative powers which you use for so many things and prohibit manufacture, supply, sale, distribution and consumption of cigarettes, whether in public or in private. Public shall be defined. Okay, you ban it in such a manner that nobody can survive. So, but no, they want the revenue. They still want the revenue. It's a very, very quickie game they play. So, state also plays the same game as far as alcohol is concerned. So, it's a sin tax which comes in different forms. One thing which I'm not happy with this budget in terms of legislative changes, there is this concept of show cause notice. All of us know show cause notice as professionals. Sometimes we call it love letter that has come from the department. And then you go through the show cause notice, and inevitably your first defense is that the show cause notice is time barred. Because the time limit is 1 year to issue show cause notice. Beyond 1 year, the department has to establish fraud, suppression, blah, blah, blah. And inevitably, show cause will be time barred. Now, what the law is making drastic changes. Excise, your normal time limit jumps from 1 year to 2 years. Customs, 1 year to 2 years. Service tax, 1.5 years to 2.5 years. Why should assessees pay as a price for the lethargy of the department? If a show cause notice has got a time limit, it is up to the department to adhere to the time limit. If they have not adhered to the time limit, it is their problem. You can't increase the time limit 2.5 years for a normal limit show cause notice. It's too much. But that's what they've done in terms of an amendment both to central excise, customs and service tax. Show cause has changed. Another clever amendment is, I wouldn't call it clever, but it's a backdoor kind of thought process, like the equalization levy which Bhanu was talking about. See, very strangely, the equalization levy does not come as part of Income Tax Act. It comes as a part of a chapter of Finance Act 2016, even though it refers to Income Tax Act everywhere. It is going to have interpretation issues in the context of DTA also. It is supposed to be a solution for BEPS in some form. World over is debating, and now only I think Germany and some other country got to their first agreement with reference to BEPS, but India is always ahead. We were the first ones who gave a report in OECD those days saying server should be called as a PE. We are always ahead in terms of all those things. So this equalization levy comes separately as a backdoor. Something like that, Section 37B of the Central Excise Act is getting amended, whereby the board is given phenomenal powers to issue any direction in connection with the implementation of any provision of the Act. It is like 119 of the Income Tax Act. If you look at the 108 of the Income Tax Act, the circulars are governed by certain parameters. Section 37B was also governed by certain parameters. Now we are going beyond what is specified in 37B. It's as good as delegation. Now when delegation happens, circular need not be always fair. It can also be unfair. And when circular comes like that, it is law by dictation. Okay. In administrative law, there's a concept called as dictation. So when a circular comes, it is binding on the assessing authority. So it is as good as the order getting dictated from somebody above. So it's a very, very dangerous amendment as far as Section 37B is concerned. Coming quickly to what is called as this ready-mix concrete controversy. See, one thing we need to understand, we had a fantastic Supreme Court bench for the last 1.5 years. This is Lordship Sikri and Lordship Rohington. They delivered unbelievable number of judgments and settled so many issues. Fantastic judgments, and the jurisprudence has simply exploded over a period of time. One of the consequences of that was one judgment came in the context of ready-mix concrete and concrete mix. So typically there is a notification saying concrete mix manufactured at site is exempt from excise. For donkey's years it has been in existence. What the Supreme Court said in the case of L&T was there is a big difference between a concrete mix and a ready-mix concrete. Concrete mix is just putting all the sand, gravel, etc. together with labor, whereas ready-mix concrete is using technology, equipments, etc. and mixing. It's actually large-scale operations with technology. Both should be the same. But Supreme Court brought out a distinction. Now this distinction virtually hurt everybody in the industry because we have evolved. Parinama Valarchi, we've gone into all kinds of technology in terms of every site has got these plants which makes the RMC. So the industry represented to the government. The government responded. What the government responded was, they have substituted that entry 144 in notification 12/2012 by notification 12/2016, whereby they use word concrete mix or RMC. Now the moment they use the word substituted, lawyers like us will start interpreting saying it is retrospective. Okay. So we will try to say that this was the intention all points of time. So that's what you have tried to say. Because otherwise that past period is still a tricky one. But it's a very good friendly amendment in response to government's industry's representation. Coming quickly to customs. For so many years, there was this entry called as drawings, plans and designs in the customs. nil rate of duty. If you import plans, drawings, customs, etc., it is nil rate of duty. Quietly, that exemption has been withdrawn. So from tomorrow, basic custom duty of 10% is applicable on import of plans, drawings, and designs. Now, please understand, it has got different kinds of connotations. Plans, drawings, and designs, if you treat as goods for the purpose of custom duty, fair enough. You will treat as goods, you will pay the custom duty. But the service tax department will say, no, it is not really plans, designs, etc. It is actually a bundle of know-how. Therefore, it falls under reverse tax mechanism. You please pay service tax. Then your DTA, your Income Tax Act will also look at it and saying that is it fees for technical services or it can be fit into goods or not. Now, whether this amendment will help you to argue that it's well established as goods or not is another point. But this is going to open a big Pandora's box. As if this is not enough, there is another act called as Research and Development Cess Act 1986, which levies an R&D cess of 5%. See, foreign payments today is a big challenge. You have your withholding taxes, where the foreign party doesn't agree, therefore you have to bear the brunt of it. You have an effective 14.5 service tax, and then there is a cascade because of all these things. So if you are not negotiated your contract very well, you will end up completely being wiped out of business in terms of foreign payments. So customs, there have been some changes. I will skip it for the sake of brevity. Quickly going to service tax. Bhanushekar, very clear. When you said that I don't know service tax, I agree. Service tax was never 1%. It was never. It can never 1%. They'll always get upset if you say it's 1%. They started with 5, grew to 8, jumped to 10, jumped to 12, came back to 10, jumped to 12, jumped to 14, added 0.5, and one more 0.5 is coming. And this 0.5 comes very cleverly. It is called as Krishi Kalyan Cess. Nare Hindi kathukalam. Adu in the part of the world namakku Hindi prarthame kadiyadu. Okay, I think we are in that kind of generation where we never learned Hindi. Our Hindi limited knowledge were Doordarshan to some extent, and those some of those serials that came. Oh, adula enak pudu vaathu enak theriyadhu. So now we learn a lot of new things, which is so. I asked some of my juniors who are well versed in Hindi, what is this? So they all gave them literal interpretation. Krishi means farmer, Kalyan means welfare, farmer welfare cess. So we now have KKC. Earlier it was SBC, Swachh Bharat Cess, that came in the middle of the year. So now all this, KKC, SBC, KYC, everything comes into the picture. Like again in Tamil Nadu, Ka, Tika, Muka, Maka, Tamaka, different ways. So all those things are only reflected in these kind of format. This Krishi Kalyan Cess is applicable 1/6/2016. Dates are announced in the legislation itself. 0.5% on value. Now they have learned the trick. Earlier it was on tax. There was this confusion whether it was on tax and value. Now they very clearly learned this. It is on value. So 14% service tax, 0.5% Swachh Bharat Cess, another 0.5% Krishi Kalyan Cess. Effectively you are paying service tax of 15%. Now you should be happy about it because we were all thinking that 14 can go to 16, in which case it is 16.5. See, I am a big movie buff. Most of my friends know. General theory about a movie is that if you go without any expectation, the movie is nice. So if somebody says the movie is fantastic and you go and you don't find it, you're disappointed. And the Madri budget, everybody was convinced that it is going to become 16%. 100%, 16%. So when 16% did not happen itself, it became a good budget. So 14.5 plus 0.5 by 1st June, we'll all be ready to 15%. But mind you, this nuisance of KKC is that it is a line item. So you have to charge it separately. Again, you have to spend on software to get your software upgraded to get that line item invoice. It's such a pain. In fact, way back in 2004, when Mr. Chidambaram brought this irrigation cess of 2%, it was next after excise duty. So a lot of companies struggled, especially these. For new companies, they didn't have this wherewithal. So they had to spend a lot of money getting their software updated to get the invoices. Old traditional companies which were in India for so many years did not bother at all. Next day they were operational. Next line item, education cess. And they said that inna oru 3-4 line irukku. Okay, we are ready. Okay, I am waiting. So if you put, we'll put. So that kind of attitude was there. So now all our foreign company friends have also learned this exercise. I'm sure the latest software will have adequate clauses to cover this. But mind you, it comes when the provision comes into force on 1/6/2006, you must be ready to add that. Negative list, there is this favorite tinkering. Remove something from the negative list and put it in the exemption. I don't know what kind of pleasure you get out of that. if something is there in the negative list, it's a parliamentary mandate that it is not liable to service tax. If you remove that and put into an exemption notification, it at the whims of the bureaucrat who can simply rescind that notification. We are just giving away, delegating power after power to the government and board also. So we are going away from legislation. So probably the experience is also pretty difficult. It is very difficult to make law in the parliament today. So we may as well delegate to somebody else who is much more having freedom to do things. So the executive fiat is much more stronger. So there are changes in the negative list which have happened. And as usual, one more attempt to nullify a judgment. This lottery business. We have this lottery business where the state announces a lottery and there is a distributor who deals with the lottery. He gets the lottery at, let us say, 80 rupees instead of 100 rupees. He makes his margin and sells at 90 rupees. We had this income tax question whether 194H will apply or not, whether this constitutes commission or not. Matter went up to Supreme Court, Ahmedabad Sam and Das case. They said it is not a commission. They said it is distributor, profit, etc. Service tax came with its own avatar and said that this is an agency, you have to pay service tax. Matter was challenged. ASSI won the case in Sikkim High Court. They nullified that judgment and made an amendment. Finance Act 2015. That amendment was challenged by the same assessee in the middle of 2015, and before the end of 2015, judgment came knocking down the provision of Finance Act 2015. Fastest delivery of justice. You know, the section that came from Finance Act 2015 died by court striking it down. So now, Finance Bill 2016 has given one more attempt, saying that under the state law, there cannot be a distributor considered at all, it is only an agent. Therefore, we can't treat you as a distributor. So this, again, I'm sure that company is going to challenge. Because primarily, what was said in the judgment has not been addressed in the amendment. We have this declared services, and now the government declares, vehemently saying, assignment by the government of the right to use the radio frequency spectrum and subsequent transfers is declared as a service under 66E. Now, why are they suddenly jumping and saying it is a declared service? Because there is a huge degree of interpretation as to whether spectrum is goods or service. If it is goods, then the VAT authorities are going to come and collect tax. If it is service, then reverse charge mechanism, somebody else pays the tax. So they have jumped, they have taken the lead and said, we are declaring it as a service. Now, by doing so, there are interesting thought process. You are now saying, assignment by the government of the right to use the radio frequency is declared as a service, which means all other right to use transaction can never be a service except this. This is what we've been saying from donkeys here, saying that right to use goods should be treated as a sale and should never be treated as a service. So you're getting more teeth to argue, saying that look at this provision, that's how it's looking at it. We always have this problem with this point of taxation rules. When is it effective? They put a new levy of service tax, 12 became 14, 14 then became Swachh Bharat Cess 0.5. Whether Swachh Bharat Cess is applicable for the period prior to 1/6/2015 was a big debate. I also wrote an article saying that section 67A is supreme. You cannot read anything more into 67A, a section would prevail over the rules. You cannot apply the POT rules. Apparently somebody has read those articles which have been there in the public domain and they've captured that, saying 67A subject to rules, POT. So now POT has also been amended, so all these new levies will also be governed by the POT. Interest. At last, somebody has listened and said that, yes, what we are charging interest is abnormal. Because we are charging something like 18% for 6 months, 24% for 1 year, 30% for 1.5 years onwards. Unbelievable interest. So finally, lawmakers have said 18 itself shall come to 15. Only in cases where you have collected the tax and retained it, it is 24. Otherwise, your normal rate of interest stands at 15, which is something fantastic. Prosecution, somebody has again listened. They have now said, instead of 50 lakhs, the limit goes to 2 crores. Only if you have collected service tax and kept in your pocket for more than 2 crores of rupees, prosecution. Otherwise, no prosecution. Suddenly, last year, you had various new kinds of prosecution happening in service tax. Now, there are clear language as to what kind of prosecution is possible or not. Last year, if you remember, I spoke about how government has withdrawn so many exemptions which pertain to infrastructure, airport, ports, etc. I also mentioned a point saying that a lot of companies have signed up contracts which will spread over 3 to 4 years. These contracts were signed at a point of time when the exemption was there. Therefore, they've quoted without the service tax. And you withdraw the exemption, you get into all kinds of problems. Very cleverly, they've made an amendment saying that if you have executed contracts before 1/4/2015 And those contracts are going to run up to 2020. Don't worry, your past contracts are safe. Only contracts executed after the amendment, the exemption is withdrawn. That is pretty good. Somebody is really thinking in terms of what should be done and what should not be done. And then they have exempted SEBI, they have exempted IRDA, they have exempted EPO, EPFO from service tax. Now, whenever an exemption comes, it is risky. Apuna ivula varshama na taxable. See, when an exemption comes, only you realize that you are actually in the tax net, because why should you exempt unless you are taxable? I am sure Shoka is going to follow to all these authorities for the past period. So this exemption can always work very peculiarly. Coming quickly to reverse charge mechanism. This grievance which chartered accountants always have against lawyers. You guys don't pay service tax. We are always paying service tax. We keep on having this grievance. I don't understand this grievance at all. Lawyers provide services for which clients pay service tax. Government gets the money. The question of compliance alone does not exist. But the service tax is clearly there on legal service. It is shifted to the client. Now, for some reason, they found a distinction between senior counsel and normal lawyers. And they said that for senior counsel alone, senior counsel shall pay service tax. But unfortunately, the board circular gives the language saying, senior counsel shall be subject to a forward charge of service tax. This is not a pudu term. Okay. So one of my juniors said that, what is this forward charge of service tax? Unnillamma, itna reverse charge indide. Ipo opposite, forward charge. Which means the senior counsel is a service provider, he has to pay service tax. Earlier also he was billing and the client was paying service tax. Now the senior counsel has to register and file his returns. So they've brought this kind of massive change, so-called, in the reverse charge of service tax from 1416. Please be ready for government-related service tax. Services provided by government or local authority. The law has been amended. 1416, provisions are kicking in, reverse charge mechanism kicking in. We will now have to sit and examine whether the fees paid to MCA for uploading of files attracts reverse charge mechanism or not, whether the fees paid for approval from CMDA, whether it attracts service tax or not, whether there is a difference between a tax and a fee, whether it's a sovereign levy or a mere administrative collection. All those debates will now start, and we'll have to examine, because the liability is on the receiver and not on the provider. So this is going to be a very significant amendment. Coming as a last point, I'll come quickly to SENVAT credit. The finance minister seemed to indicate that the law is being drastically changed to improve the flow of credit and ease the entire SENVAT credit process. So even I was sold, okay, they are amending input service definition, we are going back to pre-1411. Nothing, no change to input service definition. Small changes here and there. From now on, office appliances are also capital goods. You can enjoy. Earlier it was not capital goods. There was always a debate as to whether a computer is a capital goods or not. For a processing unit where the entire system is governed by systems and computers, it will be capital goods. For a non-processing unit, technical unit, the laptop used by the foreman playing solitaire will not be capital goods. Okay, that was the line of distinction which we used to argue for capital goods. Now they've said, okay, take all office appliances, you enjoy the credit. Usage outside the factory also to some large extent. One phenomenal amendment is in the context of job workers. See, typically what happens, take a FMCG company which manufactures soaps. They own the brand. They engage a job worker, make the job worker manufacture everything, pack everything, and then say, please supply it to my depot, I will sell it. Now the job worker pays the excise duty because he is the manufacturer. But this company incurs all the ad costs, marketing costs, selling costs, distribution costs where service tax was there and credit was not possible. There are a lot of interpretations as to whether credit is eligible or not. Finally, they've amended the law saying that, don't worry, even for goods which are outsourced and manufactured, you can take this SENVAT credit on these services. So something very industry-oriented, again, practical amendments have been made. Rule 6, which was our favorite rule, has now been recast completely in terms of what is A into B by C, D, E by F, G, H, I, everything you have to go again and read again and then understand this entire formula. In fact, my office team were very worried saying that, sir, I have to give you the exact formula and how to implement it. I said, don't worry, nobody is going to be interested in what is E and F at this point of time on the first day of the budget. It will come. It will take some time to come in. Lot of amendments, and here also we have the indirect tax dispute settlement scheme, again confined to commissioner appeals. Pay only the tax, certain percentage of penalty, walk out of the scheme. But the best part is in the legislation itself, at the show cause notice stage itself, you have this provision in indirect taxes. At the OIO stage itself, you can walk out of paying the tax and pay 25% of penalty. So I don't see a very, very big incentive in terms of this particular settlement scheme. There is no Samadhan scheme. There is no disclosure, VDIS kind of thing like in income tax. But somewhere I saw in the VDIS scheme, no questions of service tax will be asked in that provision. So that's an interesting thing which I thought. There is also CST getting amended. There is an explanation to section 3 in the context of gas, saying that my gas and your gas co-mingles and both of us go to the doctor for digestive problems. There is no issue. It is still interstative still. So that kind of provisions are vague provisions which link the pipelines have all been brought in the statute. This budget is just what I've given you is a tip of the iceberg. There are so many other technical small amendments which will be highly technical but relevant from a client perspective, from an industry perspective. And I think they've spent a lot of time in preparing this budget. It's not so easy to prepare a budget of this comprehensive nature, going everywhere, right from direct tax, from what you heard from Bhanu and what you heard from me. They've touched almost every segment in some form or other, whether it is a rule or a section or a situation or rectifying an anomaly, talking somewhere about Vodafone to see what can be done about that. Everywhere they've done something. So I think in that sense, it's a very, very welcome budget. Of course, we need to see what the media will say. I'm sure they would have talked about saying it's, if you go do for agriculture, they'll say it's a farmer budget, election budget. If you don't do for agriculture, they'll say it's a corporate industry budget. If you do for both agriculture and corporate budget, they'll say common man, nothing is there. If you do all these things, what is there in the budget? Every time you do all these things. Thank you for a very patient hearing.
Members, it is our least courtesy to show some respect to the speakers. If you have patience, kindly be seated. I request my colleague in the Regional Council, R. Hemavati, to give a memento to Sri T. Bhanusekar. It doesn't mean that he is not going to speak afterwards. Any two questions he is going to answer. I am requesting him, not this thing. Yes, sir, kindly. Because majority are leaving, I would like to do this present job. Similarly, I request J. Murali to, is an indirect tax man. Please present a memento. Yes, sir. Your fraternity. So to present a memento too. Now, 2 questions on direct tax and 2 questions on indirect tax. Please, you are raising the hand.
Good evening, sir, and certainly an excellent presentation. Even Mr. Arun Jaitley didn't put us to sleep, and neither did both the speakers. One thing what I really liked, what Mr. Jaitley said when he started his budget was, लहर लहर तूफान मिले, मौज मौज मझधार, फिर भी दिखा देंगे हम सबको, आता है हमें किन मुश्किलों से करना नौका पार. I think Ms. Shri Priya can translate.
You only quickly.
Yes, sir, I really appreciate whether it is a election budget or a corporate budget. Certainly nothing done for women. Firstly, yes, okay, I agree only with, and secondly, what I want to know is investment perspective. What is it that has been done to encourage investment into India? Vis-a-vis the foreign options of investment that people have today, with FD rates going down at 7.5%, what are the provisions given for to encourage investment in India? That is my basic question. Thank you.
Any encouragement?
See, first of all, this, I think we need to get beyond this budget document being the most holiest document covering everything. It's supposed to be a revenue expenditure statement and nothing beyond that. We have given it too much of, prestige and mileage, and we expect everything to happen through the budget, and budget seems to be the only solution. Foreign investment will happen. India today is one of the most significant markets in the world. And with China going over this kind of collapse in this kind of hungry market, whatever positioning any investor takes outside, whatever he comments about this and all that, he will ultimately need this market. So whether they like this country or not, whether they accept this policy or not, you will find themselves walking in. And if you look at Mr. Jaitley's statement very cleverly, he very clearly says, in the given global scenario where things are pretty bleak world over, I want to ensure that this budget increases domestic investment and domestic consumption. If domestic consumption goes up itself, we'll have phenomenal growth. And that seems to be the whole target of putting some money into your hands by tweaking with your house property benefits, putting direct transfer into bank accounts of farmers to get those things into their, putting subsidies directly into their funds, putting, all kinds of money in hand because people want to spend. So we should not be really worried about the direction which the budget takes in terms of foreigners. Foreigners will automatically happen because this is one of the key destinations compared to other rest of the world. Where is the growth? Just look at countries in terms of growth percentage. There's no growth. And if you look at UAE today, it is very, very scary. Women, she wanted to answer.
Later.
So for direct access.
Yes.
I'll give my
Section 281B, if a bank account is attached, whether by giving bank guarantee, bank account can become operational. 281B. Bank account.
See, it says 281B talks of provisionally attaching a property. Normally, a bank account is not attached under 281B.
Was attached with the JC's approval.
281B?
Yeah.
281B cannot be done with the JC's approval.
No, the DC has the JC and they are attached it.
Sir, 281B cannot be sir, you are talking of an attachment after a demand or before a demand?
Before demand.
281B, sir, 281B.
No, salary account was attached.
Sir, please allow me to answer.
Yeah.
281B cannot be done by a joint commissioner at all. It can be done only by a principal commissioner, a commissioner, a chief commissioner.
No, it happened 3-4 years before.
How many ever years it happened before, it cannot be done. So please challenge it. The 281B itself is bad.
So bank account cannot be attached with
Cannot be attached, and it can never be attached by a joint commissioner in any case.
Right, sir.
So both ways it is wrong. Yeah, I'll repeat the question.
No. Okay. So in the budget speech, Finance Minister actually said this regarding the place of effective management. He said he'll defer it by 1 year, but actually, it is written that it is applicable from assessment year 16-17. So.
No, he says 17.
Okay, yeah, 17.
So it will be applicable only from assessment year, next assessment, 18-19.
It is written as assessment year 17.
In the memorandum explaining the bill, that appears to be a mistake. In fact, if you look at the memorandum explaining the bill, there are other mistakes also.
Okay.
Even the tax rate, if you see, it says effective from assessment year 14-15, financial year 14-15, 15-16. 15-16 is over.
Cut copy mistakes.
So there are some copy mistakes.
Okay.
See, first round of Avatar of 2005 was you need to fix a mark which will be seen as a brand. Second Avatar of 2010 was sold under a brand. Third Avatar, nothing. Jewelry. Only safety they've provided is, there's a small scale exemption notification also amended. Up to 6 crores there is no duty. Provided last year, previous year, 12 crores is your eligibility limit. If you have not crossed 12 crores in the preceding financial year, this year 6 crores exemption, and for the month of March 16 it is 50 lakhs exemption. So all the small jewelers will be out of the system. Very small jewelers. It's very difficult to find a small jeweler. Very small jeweler will be out of the system.
Sir, this KKC, it is for only service tax or it is for central excess duty also?
Yenga, poor me. Only service tax 0.5% on the value of taxable services.
And it is not semi-matable, sir.
See, KKC, they are going to play it in a very clever way by saying that you will get the benefits. It is not going to be like Swachh Bharat says. Whereas infrastructure cess, which I forgot to talk about, is going to be a different game, where you will not get the credits. Each cess is being treated differently.
Incidentally, this KKC is also there in the income tax to a limited extent, where that you have this something like the voluntary disclosure, income disclosure scheme. I said 25% surcharge, that's a KKC surcharge. I don't know how it makes a difference though, but two other things which I also missed. One is 206AA, the finance minister's speech, he says that if you provide alternate documents as may be specified, then 206AA, the higher rate of TDS will not apply. Apparently, the Justice Issue Committee recommendation says that if they can give, instead of a PAN number, if they can give their domicile certificate or something like that. So that would be one redeeming feature. And two is, honestly, the most interesting thing about this budget is I did not see any amendment to get over decisions, not even prospectively. Whereas earlier we used to see everything retrospective. Very, very welcome. Great.
Last question.
Assessment proceeding, lately to the face-to-face assessment is not required, only online will be permitted. So how will you apply in the?
No, he is not saying only 1 minute, sir. The speech or the bill does not do away with face-to-face assessments. They are wanting to phase it out over time. So it is only a beginning that they have made. It is not that from tomorrow you will not go to income tax department. No. You will continue to go over time. It will become, they will face off the face-to-face assessments.
It will be applicable scrutiny assessment and CET.
All scrutiny, reopened assessments, everything. The only amendment they are making is hearing means documents that are filed through a e-mode.
E-mode. Now
That's the only change.
Yeah. Now we are filing the CET appeals e-mode only now.
No, sir. CIT appeals, you are only presenting your appeal by e-mode.
Yes.
The form 35 and the grounds are alone presented through e-mode.
Yeah.
The hearing is personal.
Okay.
The assessment, they are proposing that the assessment itself will become impersonal. That is, they raise a query, they send you a mail, you reply by mail with all attachments. That's it. That's how they are looking at it over time. It will not happen tomorrow.
Okay. Maybe a personal hearing also.
You also fail the test of value.
Equalization levy, which has been explained in the context of BEPS, which actually relate to income. Therefore, would there be a challenge to its virus, or would there be any issue relating to the preponderance of double taxation treaty, where the treaty provisions will override any domestic law? Because this is a reference to BEPS, they are saying, and therefore it is profit related. Will there be a possibility?
See, logically, there is absolutely no reason why something like the equalization levy should come. For only one simple reason. In my understanding, if a person does not have a PE in India, he has nothing to do with India. India is not providing either the infrastructure or the support or anything to collect taxes from that person. Therefore, India is not entitled to the tax. The only thing that emanates from India is probably the order for which India is doing nothing. Therefore, it should not be subject to tax in India as a concept. Now, somewhere they seem to be bypassing this, going one step further and trying to bring an equalization levy. As you rightly pointed out, sir, they are making reference to the BEPS for this also, which again has no logic. Because BEPS is in respect of a profit, which anyway does not accrue or rise in India in this case. Certainly, the treaty should override the equalization levy. Logically, wherever we have a treaty, equalization levy cannot be charged. That will be the first point. But then, please note that the equalization levy is on par with the TDS. So, the department can still come back and say, we are only asking TDS. If he wants to file refund, let him come. What happens in that case? These are all questions that we have to ponder on. Now, question of challenge, I think surely somebody is going to challenge the virus, and certainly SCs have a good case. This is somewhere a bureaucrat playing a trick with tweaking things to make it appear that they are being very fair. So very unfair levy cannot be subject to any sense of logic or rationale in it. Vaidhi, any points on this?
Yeah. See, I think I also talked about it. It is trying to extend this concept which is yet to materialize. See, if you look at world over, if you look at who's driving BEPS, BEPS is being driven largely by developed countries who find, thanks to this, Apple companies and other major companies who have treaty shopping, and they don't pay significant taxes in certain countries where they are domiciled. So, in order to get over that, this OECD thought process came. They talked about virtual Ps. They talked about whether market can be called as P. They talked about, what is booking an order. All those things have been part of debate. And OECD has talked about it in multiple series of papers. Is India such a country so ahead in international tax, so superior in terms of tax implementation, that we should implement this now? There is absolutely no warrant for us to jump the gun and try to talk about this. Maybe, in fact, US is completely stepped away from BEPS. They are not even in this picture. Most of the developed countries are still thinking about what they should do in terms of this particular thought process. We seem to have jumped the gun with that too, with the new levy. And this kind of levy, I'm sure, by the time the noise is made, you will have an amendment in Finance Bill 2016. The effective date will be shifted by 1 year, 2 years to like the GAR, story. So that kind of thing has to happen. Then you will have other peculiar issues. Of course, there is some degree of thought process whether this payment will attract service tax or not. Then imagine a situation where somebody says that this equalization levy is also a payment, therefore 195 should come. There is no end to interpretation if you start talking about it. They've said that. So, the name itself, equalization levy, what are you trying to equalize? This will fall flat if you look at it as a challenge. If you look at countervailing duty, you have a logic to say to countervail the effect of excise duty, you are putting this. If you want to say equalization levy, what are you trying to equalize to bring this levy? That will be a very legal question.
Equalize the collections.
We'll wait for the legislation. We'll definitely look at it.
Yes, members. So we are coming to the finality. I request our Central House member Sri Priya to propose the vote of thanks to complete the total thing in 3 to 4 minutes maximum.
The Chairman, Shri Palgun Kumar, our eminent speakers on the dais, ladies and gentlemen, here's a very hearty good evening to all of you. Yes, I remember, 3 to 4 minutes and that's it. I'd just like to take Naina's question first on women empowerment. I've said this before, just look at this. The most important portfolios in the 33 crore pantheon of Hindu gods are held by women. It's Lakshmi for defense, Saraswati for learning, Shakti for defense, and Uma for agriculture. So we stand truly empowered. So I'm fine with this. That apart, I'm given to understand that there is content in it for women as well. So, just to very quick, a minute's wrap up on the budget. I think one of the first things that was mentioned was that the FM was looking to double agricultural income by 2022, 100% increase. And that is supposed to funnel or fuel enormous amount of growth for industries as well, which is why the corporates are not going to, the industries are not going to have much to complain about the budget. It's obviously very, very focused on startups and make in India. There are exemptions for new companies coming up. Third is you can distinctly see that move happening from 30 to 25, the tax rate, because now sunset clauses have happened for 10 AA, 35 AC, 35 CCD, 80 IA, 80 IAB and 80 IB, which means that's how the balancing from the 30 to 25 is going to happen. And your 32, which is the depreciation 100% has now been slashed to 40%. So 35.1, 35.1 expenditure on scientific research, 35 AD, 35 CCC, all of it now are going to come with deduction restrictions. So which means essentially a lot of people are going to pay the same amount of money end state. The third thing I think in this budget is that somewhere along the line, I think the tax department has figured out that their own cost of transactions is very high, which is possibly why you see that there is a relaxation in TDS rates. There's a relaxation in 45 AD, 45 AB also for profession from 25 lakhs to 50 lakhs. I'm sure they do also have cost per transaction which must be mounting. So instead of wanting it on a, there must be a mismatch between cost and revenue. The fourth, and both these gentlemen have sort of repeated, yes, I think we're moving towards a non-adversarial tax regime. And the fifth is, of course, my pet subject. The FM made a very, very significant observation on the Companies Act. Very, very recently, they had notified 104 changes in 78 sections as a draft. The FM has reiterated that these changes are going to come, which means we'll have a lot more programs on Companies Act, and welcome to all of this. And ladies and gentlemen, in summation, I'm extremely thankful to these two gentlemen. In fact, I recollect Mr. Bhanushekar 2 years back came back and said, I have nothing to speak about. And Mr. Vaiti had so much to speak about, and today the roles are reversed. He had very little to speak about, and he had a lot. So, be that as it may, it's the end of part 1 of Budget 2016. Wait for our clause-by-clause analysis, and I hope we'll turn out in as large numbers as possible. And thank you very much for your patient hearing. Thank you very much.
Congratulations, Bharat. Thank you, sir. Thank you. Thank you. Thank you, sir. Christian, that.
The chairman, change the number of what? 24th advance mission, 25th I was not in town. Probably I thought you were changing number. Same number than I called you a couple of times. You were busy with the election. All the very best. Bano, as usual. Bano. Sir.
I couldn't meet you, so I thought of calling.